I think it's one of the most promising money movement innovations in decades. I think the big change that we've seen is that the regulators have actually classified stablecoins as funds, so you can treat them as money. And that's why you see corporates accelerating adoption of stablecoins as one of the new tools in the Treasury toolkit.
How accessible are these money market funds on a blockchain for the corporates?
Getting better and better, but
Arnoud Star Busmann is the CEO of Quantoz, a regulated stablecoin issuer based in the Netherlands, and a partner at the T3i Partner Network. He works at the intersection of digital assets, fintech, and global payment infrastructure.
everything that you would want, you get. Therefore, it's a far superior settlement tool. Moving from just in case to just in time is going to be the big shift.
Where do you see stablecoin as a payment methodology in a few years' time? And what would be the role you foresee in corporate treasury operations?
I see it as the
Welcome, Arnoud. Stablecoins have always been a topic which was mainly interesting for retail investors who are active in the crypto community. Lately, they have been making headlines among corporate treasurers as well. Arnoud, how should corporate treasurers nowadays think about stablecoins?
I think it's a fascinating tool. I think it's one of the most promising money movement innovations in probably decades. It's nothing to do with crypto. At least not, that's not the way I look at it, right? It's a very disruptive ingredient for the Treasury toolkit. And particularly because settlement it completes so quickly, also cross-border, with finality and almost for free. It really cuts down on many of the traditional costs and the complexity of settlement. So it's a highly disruptive, highly useful, valuable ingredient in the Treasury toolkit.
All right. And how should, corporate treasurers think of stablecoins, the underlying mechanics? Because, I've been active and using stablecoins for many, many years, and I've seen many different forms of stablecoins coming along. Some not so successful, such as algorithmic stablecoins. But corporate treasurers might have also heard of CBDCs. But what exactly distinguishes a stablecoin from these other forms of, stablecoin-like type of coins?
I think some of the boundaries are blurring, but if I look at, let's say, algorithmic stablecoins, I don't think we need to talk about them. They derive a value from something external, could be commodities or secondary markets. If we're talking about money, then there's indeed multiple forms. The CBDC, you hear about tokenized deposit and stablecoins. I think CBDC is and there are multiple forms of that as well, but it's about money creation. So if you, as a central bank, issue a CBDC, you're actually creating money. So it's also a monetary act rather than a technology act. If I'm talking about tokenized deposits, it's money that already has been issued. It lives in a bank account, as far as you can call it issued, and it's tokenized. So it's another way of using money to pay, but it's very much in a closed loop. Only somebody that has, let's say, an account with the same bank, if a bank is the issuer, can actually exchange that token money back for fiat in the bank account. So it's limited in utility. Stablecoins are interesting because they can actually do multiple things. They are backed by real money, and if your money that is sitting in multiple banks or in safe assets like highly liquid financial instruments for his money markets, and they should always have a one-on-one backing. And if they're regulated, there's very strict audit rules to make sure that they are indeed backed. And what's interesting about stablecoins is that they can derive their value in two ways. One of them is, hey, I should always be able to go back to the issuer and get one-for-one fiat money, or I can trade them in secondary markets, which tokenized deposits can't. And in those secondary markets makes me less dependent on the issuer. But there's some potential market price fluctuations. So a euro stablecoin might be 0.9999 euro or 1.01 euro instead of just exactly one. I think for the interest of treasurers, let's really focus on these regulated stablecoins, because I think that's where the value is.
Yeah. So if I understand correctly, like for every stablecoin I have, I can redeem it for a real dollar or euro directly at the issuer of the stablecoin. But in practice, that is, well, almost never done because you can also just trade them on secondary markets or just send them or use them or keep them. So the redemption mechanism is not often used. Should I see it like that?
Yeah, not yet. I think traditionally, you go to a secondary market like a crypto exchange or an OTC broker, and you do the exchange there. I expect as this is being used more and more in, let's say, corporate treasuries, real world use cases, that it's going to become more important for treasurers and corporates to have direct relationships with the issuer, because it basically reduces the redemption risk. It reduces dependency on the market. But quite importantly, if you can redeem with the issuer like instantly, then it's not unlikely that your auditor will let you book stablecoin holdings as cash equivalents on the balance sheet, which then removes the need for that redemption and removes a lot of friction from treasury operations. So I think that direct relationship with the issuer is going to become much more important, and that companies, issuers are setting themselves up as well to make that possible.
All right. And well, when you think of stable coins, I think there are quite some misconceptions among treasury teams. They are, well, we discussed it already a few minutes ago, that are traditionally seen as cryptocurrencies. What has changed over the last couple of years? What is now changing so that treasury teams are becoming more and more interested in the actual use cases underlying these stable coins? Because if I look on my LinkedIn, I see, well, a lot of headlines nowadays with stable coins, revolutionize payments, and all kind of other headlines. But what is now slowly changing so that stable coins become more popular?
Yeah, it's an interesting one. I have the same problem with my LinkedIn profile. The algorithm is really polluted with stablecoin. Sometimes hype and sometimes very interesting, relevant information. I think the big change that we've seen is that the regulators, like the ECB, have actually classified stablecoins in the EU, as long as they follow certain rules, as funds. So you can treat them as funds, as money. And that makes it legal tender to purchase goods and services. It gives it a value, it gives you redemption rights. So it links it directly to the underlying money that's been issued. So it gives it a legal status. It also gives it removes a lot of the risk, and not just the redemption risk, but also the reputation risk and the regulatory risk. Right. So I think that's been the big transformation, and that's why you see corporates accelerating adoption of stablecoins as one of the new tools in the Treasury toolkit. Big difference with crypto assets is that crypto assets usually, they're backed by nothing. They're backed by belief or maybe utility in a specific business model. But to get your money back, you are completely dependent on secondary markets, and we've seen that the value can go from 1 to 0 very, very quickly. So I think stablecoins are now as far from crypto as money is from shares in early stage VC-backed companies, for instance. So it's a really a big chasm that's been created, and it's a chasm between the real world and the crypto markets is where a lot of the excitement comes from.
All right. And Arnoud, you have joined Quantoz, which is a stablecoin issuing company, as a CEO. What made you, well, end up joining a stablecoin company? Because looking at your background, you have worked at banks, technology companies, and why you decided to make this shift towards, well, becoming the CEO of a stablecoin issuing company.
I think it's been a natural progression of things that I've been doing in the past. Right, I've always loved the innovation. I would love building companies. I love startups. And when I was working in a bank, I spent quite a lot of time learning how stable, or not stable coins, but blockchains can really change the way market actors exchange value. Sometimes that value is information, Sometimes it's money. And I spent quite a lot of time at ING Bank, and particularly in their commodity business, looking at how we could digitize the underlying paperwork associated with shipping oil or soybeans or other commodities. Right? There's a lot of parties involved in making let's say, shipping oil from Uganda to China, for instance. And there's a lot of information being processed, and a lot of the risk in that shipment, particularly financing it, is associated with having good grip on the collateral, and that relies on very good information. Using blockchain technology helped us to get very confident on the information that's being used, which makes it possible to settle contracts very, very quickly, also on the physical side. Now, if you can do the paperwork really, really quickly, then the next step is, okay, well, let's get paid instantly as well. And this is where it breaks down. We saw that paying via the regular banking system can still take many days, particularly as a lot of commodities come out of, let's say, what we call the global south, quite far from, with banks quite far from the Fed in New York. So the correspondent banking network wasn't really set up to meet that, let's say, delivery versus payment objective that is so attractive, and where you want to close that gap between the two. So as I ran a company in Canada as well for a while, focused on mining and metals, and running into the same problem. Great in digitizing the information of the physical leg of a trade, but not the financial leg. And I started looking at what we could do there, particularly tokenizing some of the debt instruments like trade finance, commodity trade finance. And then slowly started looking at stablecoins as the real game changer. And around that time, I was someone introduced me to this company in Utrecht called Quantoz. And I went for coffee, learned about what they were doing, learned how they got a license from the Dutch Central Bank, which is a tough regulator, to issue electronic money on a public blockchain, very innovative. And I went back for a couple of more coffees, and they asked me to become CEO. And I was actually didn't have any good reason to say no, so I jumped. I took on that role, and here we are. That's so.
Well, that's a nice evolution. And well, if I hear you, like often the payment in stablecoins can go hand in hand with a much broader form of well, doing things on a blockchain, on a shared ledger. Can you elaborate some of the use cases? Like, for example, you mentioned, well, we had a digitization of the whole payment process across a certain supply chain. Like, how would that work in practice? Like, can you give an example there from companies you worked with in the field? And because I think it's not only the payment you're talking about, but also the processes surrounding that when would a company get paid?
Yeah, I think that's really important. So particularly in supply chains, let's say settlement is a key point, because at that moment, the settlement has two legs. Like you need to exchange the physical goods or potentially a service for payment, and any gap between the two opens up to risk. And this risk mitigation of the gap between delivery and payment can be very expensive, because there's FX involved, where FX rates can change. There's a settlement risk. Is the money actually going to arrive? There's a credit risk as well. Are they going to pay? Can they pay? So all these things need mitigation. And the bigger the gap between the moment of delivery versus the moment of payment, the more that risk mitigation costs. So if you look at supply chains that operate on basis of delivery versus payment rather than a letter of credit, then you visit a coffee producer is not going to hand over control of the coffee until they've got money sitting in the bank. And that money sitting in the bank costs time to arrive. So if the money takes a number of days or sometimes weeks, as it can happen when it's a settlement via the correspondent network to emerging markets, that means the goods are not supplied, which consumes a lot of working capital for everybody, requires hedging against all kinds of market risk, and slows down supply chains. So if you can move money instantly with settlement finality, and is there 1 second, the goods can be released. So things speed up. You extinguish a lot of the risk associated with delayed settlement. With those risks, a lot of the costs go as well. And those costs have multiple facets. So being able to move to a atomic delivery versus payment is a great mission. And it's not just in physical supply chains, but you can also see it in financial markets, in particularly, for instance, money market funds or other investment products that always operate still at a T+1 or T+2 settlement. So if you want to put money that you have a surplus excess cash that you have on your balance sheet, if you want to put it to work in a yielding instrument, you need to be sure that you don't need the money for at least a number of days, because it will take some time to get in there and then it will take some time to get out of there. But if it can move instantly and the administration of the instrument is also on the blockchain, you can do that in smart contract, exchange it too. And there's no operation, the entire administration is automated, the records are perfect, and you are not exposed to any delays. That makes it possible to really start looking at getting your money, your cash buffers, putting them to work at all the time. If you know that you can take it out 5 minutes before you need it without any further delays. And particularly because you can verify the settlement finality, you can verify it on the blockchain. It's gone from this address to your address and it's done. There's no reversal possible, right? So, and there's nothing for, it's actually, we've given you the message that has the money has arrived. They can't use it yet because it may still be held up somewhere or withdrawn. So that risk is gone.
Yeah.
That was a long answer to a short question, but
Yeah.
I'm not, and I hope it answers.
Well, it's actually a very interesting topic. How accessible are these money market funds, tokenized, on a blockchain for the corporates? Like I have been playing around in decentralized finance myself, where it's very easy to deposit blockchains in the decentralized finance protocol and get a better yield on your cash as
Yeah.
compared to a savings account. But how accessible is this for corporate treasury teams? Like I can imagine that they have probably want to not act on a decentralized finance protocol, but rather with a counterparty that they trust, and that gives them a digitized money market fund or something similar. But how accessible are these new forms for yield optimization?
Getting better and better, but I don't think it's completely there yet. So we are working with a couple of companies that are very interested in that, because you can imagine if you need to be liquid with cash and you need to hold quite a big cash buffer to make payments for unpredictable supply chain events, that's results in a lot of cash drag. So if you can put it in a money market fund, like a risk-free, with almost like a risk-free return, and you can be liquid, it's really a game changer with regards to cash drag and let's say these suboptimal use of money. Now, so the price is big and it's moving quickly. I think originally tokenized assets really assumed that the game changer is in highly illiquid assets, real estate, paintings, cars, stuff like that. I think the learnings from the past years have been that actually as a token holder in an illiquid asset, you're worse off because you don't have any control over being able to liquidate the asset, recovering your money, completely at the mercy of the operator of that asset, the manager of that asset. And you may be able to sell back your token, but probably at a discount. So it's not great, right? So there's no secondary market for those things. So what we've seen is that tokenizing assets have actually moved from tokenizing cash, stablecoins, the most basic one, to tokenizing government debt, money market funds. And that's the stage where we're now. If I look at where the stage of the industry is, indeed, DeFi, it's already working. It's fine. But in the non-DeFi world, there's a couple of different models that we're working with. Right? So one of them is issuers that you buy directly from, but you still have like a T+1 because the underlying administration still tends to be cash-based. So you may be able to send a stablecoin to the counterparty, but they still need to off-ramp it into cash, send that money to the issuer before the tokenized asset comes in your wallet. And that can take 1 day. So it's almost there, but not really. And it's not atomic, so it relies on the intervention. What we're seeing now is that some platforms, partners that we're working with, they actually have secondary market liquidity. So they work with market makers, tokenized money market funds. They're listed on a secondary market, and you can move in and out instantly. So very close to the experience on crypto markets or other venues. I think this will be one of the first ones where we see adoption. It comes with complete custody, so you don't actually have to handle the stablecoins yourself, and it becomes an integrated experience. So from money sitting in a bank account or in an e-money account, you mint it, or you're not even involved in that as a user, into a stablecoin, goes into a wallet with a custodian. The custodian is also the market maker. They will do the swap with the money market fund, and that way you get exposure without any of the operational hassle. And so I see that one working. I also know that some funds are some issuers, particularly the American ones, are starting to issue inventory on chain. And with your stablecoin, you can go there and buy from that tokenized inventory, which gives you the same rights. And then it can move very closely to that atomic delivery versus payment. So I think that's the next one. It's probably going to be Q4, I think, when we see the first ones of those really becoming operational. The secondary market's probably Q2. I know that because we're very close to getting that working.
All right. So the market makers have quite an important role in making, all these benefits come to fruition. For example, by allowing you to quickly convert your, tokenized money market fund back to stablecoins, which traditionally, if you do it on chain, still requires a couple of days. But the market makers are jumping into this gap and providing liquidity to offer basically an instant conversion mechanism to get your liquidity back.
And that liquidity
so-
can be quite expensive. So let's see if that's sustainable, because if you need to pay a couple of basis points to the market maker for the redemption of the money market fund, that may just kill the benefit you get from a yield, particularly if you're talking about euro bonds. So I think ultimately having that direct path to the issuer is going to be a very important one, and having that on-chain inventory that you can tap into. But then you've got all the KYC and all those other things, right, that you need to deal with. So I guess the message is it's emerging, but it's not completely there yet. But I see tokenized yield as next to a stablecoin, as one of the top 3 new tools that the Treasury toolkit should start looking at and adopting.
All right. Yeah, that sounds like a logical one indeed. And coming back to that, I've talked to quite some treasury teams the last year, which were specifically interested in stablecoins, but it was more like to learn more about what it can mean for their company in the longer run. What do you typically notice when you talk to a team? Is it more like that they reach out to you driven by an interest, like in innovation? Or is it that they have an actual use case that they're looking to solve with stablecoins?
Combination of both. I think you see some sectors are further advanced in the adoption cycle. So if I think of treasurers that work, for instance, in globally operating PSPs, merchant acquirers, marketplaces, platforms, particularly ones that have cross-border operations, I think it's already there. They're already asking which ones shall we use and what are the relative costs, and they potentially switch between parties as well. So I think that's maturing quickly. Then I see in trade finance funds and trade finance platforms, we work with a couple. So the potential benefit is very high, and you can see that you can scale, right? So, and I think the complexity of stablecoins can be abstracted from the end users, which are the corporates. There are a couple of corporates that are coming to us because they want to do a collection in Europe. They've got existing They're exporters from Southeast Asia, for instance, with customers in the EU, and they want to do collections from those customers. But they don't have a EU bank account, and it's friction, and it's relatively expensive to do a SWIFT payment for a transaction that's, let's say, even 10, 20,000. It's a significant part of the margin. It goes to the payments network. So they see a way to not just streamline the collection, but also then accelerate the payouts to them. So rather than waiting for a couple of days and aggregating funds and then doing the payout, they can continuously stream the proceeds, which helps them with the treasury, removes all the risks that we spoke about, and they can off-ramp into liquidity pools at the destination. That is already happening as well. And I see the adoption more in the SMEs in competitive environments where the cost of settlement, cost of liquidity is actually a significant part of working capital and potentially the expenses that they have. And I think that's where the growth will come fast. The large corporate groups, I think they're looking at it, but I think it will take some more experimentation before that happens.
And would you also say it matters, well, the benefits of doing cross-border payments are bigger for specific countries? For example, suppose I'm a company from the Netherlands or Europe, and I want to make a payment to a specific country. I can imagine that, well, the traditional banking payment rails is more efficient for some countries, but for some other geographies across the world, the benefits might be even bigger to move to stablecoin payments. Do you see specific, countries that stand out or payment flows that stand out and that give the biggest benefit if they are brought on chain?
Oh, for sure. I think the further away you are from the Fed in New York, I think it takes longer and longer. And it's not just the number of hops in the correspondent network, it's also access to the correspondent network. It's access to foreign currency, because ultimately there needs to be a swap to a local currency. You need to have enough of the foreign currency to be able to facilitate that. So, and those markets may not be very liquid. You may need to wait some time before there's sufficient liquidity. So, for sure, the further away from the Fed, the longer it takes, and the more friction, and the more expensive it costs. The more expensive it is, and I think that also kills the commercial viability of many business models. So if you need to aggregate first a whole pile of transactions to offset the cost of the settlement, I think it's expensive. So yeah, I mean, if you have somewhere you need to pay in New York and you're based in the Netherlands, and it's a transaction of $20,000, just use Swift. I mean, it's way faster. And it's less hassle, and the cost is manageable. So it purely depends on the settlement objectives of the treasury team. So I look at it as a devil's triangle that every treasury ops team has to deal with, right? So it's the speed of settlement versus the risk of the settlement actually succeeding versus the cost. And you can optimize for one or two of them, but never all three at the same time. So depending on what your strategy is and your objective and how you optimize it, I think that determines the form of money and therefore the rails that you would use. And for certain payment corridors, I think the cost and the risk aspect are so high that you want to solve that with different rails, particularly if those rails at the same time remove any time delays, right? So that's why it's so transformative.
Yeah, got it. Okay. And how would you say, because in corporate treasury, traditionally, cash visibility is a problem. Many different bank accounts across the world. Some banks give good options for getting, what we call bank connectivity, the ability to get your bank statements in an automated digital way. Others, not so much. How do stablecoins offer that? I can imagine a stablecoin lives on a blockchain. Is it always a public blockchain? And does this fact make it more easy for corporate treasury teams to get visibility on these payment flows and balances of stablecoins?
Yeah, I think you've got perfect visibility. It's fully digital. it doesn't rely on any humans to provide you with that information. It's there's fantastic tools that help you. They give insight. You just click and add wallets to it. It's like a treasury management system on steroids, right? So across blockchains, across the world, open up as many wallets as you want for whatever purpose. It's a fantastic way to have visibility. And the good thing about it is that money is never in transit, or not really. I mean, at worst, settlement finality takes a minute or so, or 2 minutes. And if you've got, for instance, some chains that need a few blocks to settle. So in the current world, you make a payment, or your client makes a payment, and then you pray. You wait for it to arrive, and you have to chase. If you're lucky, your payment provider gives you the EOTR with the report from the SWIFT things, but otherwise you need to call your bank, and the bank needs to explain why it's taking so long. They need to do an investigation, cost you another €100 or €200. It's just really, really painful. With blockchains, there's absolutely none of that, which it gives certainty, it gives transparency, it gives visibility, it gives finality. Everything that you would want, you get. And it's therefore it's a far superior settlement tool.
Can the visibility on these blockchains also be too good? In the sense that when I make a payment to one of my suppliers, given that the blockchain is so transparent and public, like everyone can, scout the blockchain and then find out to who I made a payment.
Yeah.
What are the privacy concerns that corporate treasury teams should be aware of?
Yeah, and I think that's a incredibly valid point. I don't think privacy has been solved that well yet on public blockchains. I mean, I'm a firm believer in public blockchains versus private blockchains, as they call it, even if it's for access to secondary markets. But the privacy element is it comes with a cost in itself, and it sort of compromises the model in a way, because the privacy solutions that are out there at the moment, they rely on encryption and decryption by the single party that is the custodian of the algorithm. Now that means that suddenly you've got somebody else that's deciding on whether a transaction has happened or not, and I don't think and that breaks the ethos and the goal of having this instant settlement, verifiable finality, and I think that's a challenge. Now the other thing is, fun enough, as an issuer of stablecoins, you use technology, and if I use a third party to maintain the ledger, essentially, of balances, where it shows who's holding how much, if I give it to another company, it's an outsourcing contract. And my regulator will look at me and say, well, how can you guarantee that you always have access? What if the vendor goes under? What if it gets sanctioned? Whatever, the vendor, you don't know, right? So what can happen? So if you use a public blockchain and then the privacy is dependent on a third party, that means that there's insufficient decentralization, which essentially means that you're outsourcing to that third party. You need to have an outsourcing contract. And that outsourcing contract needs to withstand the scrutiny of the regulator. And a lot of the solutions are not mature enough to withstand that. So that's one element. The other element is that regulators like you, if you as an issuer can help with enforcement actions, being able to see what's where, freeze a wallet if needed, clawbacks, those things. And Tether is doing that regularly, Circle is doing that regularly, which is also not really decentralized, but that's the whole point of stablecoins, that it is not decentralized. Just the movement between the ledger that records the movement between wallets is decentralized. So if it's private, how are you going to do the analytics? How do you verify what the trail has been of a stablecoin, whether it's been in a wallet of a bad actor, a sanctioned actor or not? And how do you control that wallet or stablecoin where it's now, if it's private, you don't know whose it is and what's in it? So it's not just a technical complexity; it's also a governance and a compliance complexity that needs to be solved. So where this problem has existed for a long time, also in commodity trading, basically parties don't want to know who their competitors know who you're doing business with. It's a trade secret, particularly how often and what the value of the shipments of oil or copper are going to be, for instance. So if you settle that on a public blockchain, then anybody can verify that, which is not where you want to be, particularly, even especially if values are involved. So what we looked at in the past, and I think that applies here as well, you can do a number of things. You can spoof it with a lot of fake transactions that have no value, so it's very hard to determine what's real and what's not real. The other one is that every time you make a payment, you create a new address, and you pay it from there, and you mint it from an internal source of money freshly to that new address, and then maybe your counterparty does the same thing, and it's very difficult to correlate the two based on metadata. So those are ways to look at it. But I hope that the privacy and the zero knowledge proof algorithms get advanced such a way that you can actually solve those compliance and governance challenges and get sufficiently decentralized. What we look at is, as an example, is if you're thinking about corporate treasuries that you want to have multiple branches, you want to cash sweeping, pooling, move money, move liquidity between the operating companies, you probably don't want to do that on a public blockchain, right? For a number of reasons. And we look at is, why don't you do that with e-money? So if you put it on as a classic EMI, and this solution has existed for ages, some of the neo-banking apps are essentially their e-money institutions, right? So like we are. But what you achieve there is you maintain privacy and you decouple it from the constraints of the, let's say, the batch operated banking network, which has cutoff times. So you go 24/7, 365, your settlement is instant, it's free, and it's private. Only when you pay outside of that private network of your company, you switch it to a stable coin, potentially a new wallet address, then you make the payment, then you're done, right? So that maintains a balance of privacy, but gives you access to the benefits of public blockchains. And I see that as an interim situation until we solve the other ones as discussed.
Yeah, so you can create basically a hybrid setup where you do part of the transactions on a more private network. And
Yeah.
then when you need to make an external payment, the settlement is on a public blockchain, for example.
And I think that in general, come back to the earlier, that devil's triangle, it's about your settlement objectives. What do you want to achieve? And currently, you only have one way to do it, which is the correspondent network. And maybe you hold buffers locally just to do a faster payout. But now there's options. So any settlement strategy should, for a particular transaction, needs to look at what form of money is most appropriate for this. And then which rails should I use for that form of money? Speed is not the most important thing, but cost is. Just use Swift, right? And it's just do it that way. It can potentially be cheaper if you don't want to have the operational setup. Now, if you want to do settlement within your company, or let's say you've got close suppliers and customers where you frequently trade with and frequently pay back and forth, or employees, just use e-money. It's faster, better, cheaper, I think, sometimes. And only when it's cross-border, it goes outside the company, it crosses payment, the real-time payment networks, there's FX involved, then really look at, let's use stablecoin for this, because I think it's a much superior way to achieve this objective. So I think it's making that call. In a way, it complicates the decision-making, right? But it's, on the other hand, it gives optionality that is truly transformative for the cash management in companies.
Yeah, it for sure gives a lot of options. Can you maybe explain what would be the benefit for a company of implementing a cash pooling structure with stablecoins or e-money versus doing it as a physical cash pooling structure with their bank?
I think if you do it with a bank, then quite often the bank also asks you to centralize all your accounts with that particular bank and the banking network, which may not always work because the bank may not have representation in all the jurisdictions that you operate with. So you become multi-banked if you're of certain size or a certain footprint, which means double costs, double compliance. You need to keep an eye on tax implications of moving between banks, potential regulatory delays. I mean, even within SEPA, if you move money from one country to another and it's more than 200,000 euros, odds are high that it's going to arrive the next day, not the same day. And so that is not instant. That gets worse and worse. So if you want to do really fast movements of your treasury positions within the operating companies, doing that via the banking network is expensive and will cause friction and delays. If you lift it to an e-money level, you can do it 24/7, 365. It's free and there's zero friction. And it's fully digital, which means that you're, again, not relying on bank personnel being available or banking processes breaking down or other things. It's liquidity can move continuously, predictably, and reliably. And you off-ramp redeem in the location where you want to redeem it. If you have some bank accounts in multiple jurisdictions, you can consolidate it. You off-ramp at the last minute, and then you exactly where you need it to be, and that's it. And I think that's a superior way. It makes it programmable. You can automate your cash sweeping and pooling. You don't have thousands of instructions. You don't have to deal with 500 banking portals, etc. Remember the passwords, sign up all the users. It's just, no. If you're multi-banked and you've got the multiple jurisdictions, I think there's a lot of friction just in the setup.
Yeah, I think it's also quite paper intensive. Only making a change to how the pooling structure should work requires you to sign documents and wait a few days before it's implemented. So I can see the value of digitizing that part.
Yeah. So you're sort of creating a meta layer above the banks, which is independent from the bank. So there's less lock-in. And I think intuitively, it makes more sense to me to do it that way.
And how do corporate treasury teams usually deal with this? Because they are very aware of different risks, and that's one of their jobs is to manage risk. And stablecoins, of course, introduce a form of counterparty risk because you're relying on a issuer of the stablecoin. If you ever want to redeem it, or you're also relying on them to maintain the back in a way and to keep the amount on their bank accounts or in cash or cash equivalents on their balance sheet so that you can indeed redeem these stablecoins. Do companies tend to hold these stablecoins for a while, or do they usually immediately after receiving stablecoins redeem and convert them to fiat money? How do you see that working in practice usually with companies?
I think it depends a bit on the size of the company, to be honest, and let's say the mandate of the CFO and the treasury team, possibly also I wouldn't say the age of the CFO, but definitely how familiar the company is with the new technologies like blockchains and others, right? So I think the CFO is a crypto native dude or girl that trades crypto, is completely familiar with various blockchains. I think that's a different discussion. Still, I don't think you can, for the larger companies, I think it's very hard to explain to anyone if something goes wrong and you were taking operational risk or counterparty risk that you didn't fully understand. So I think it's very important to be comfortable with that. I think this is also where, so if you start looking at stable coins, you're effectively opening a bank account with a new counterparty because you're taking a risk on that party. Am I going to get my money back? So what are your redemption options? So you look at redeemability and liquidity. Liquidity comes from position in secondary markets. How many exchanges are there? Are there OTC brokers, etc., that I know where I can exchange this? And what is indeed the peg? How much liquidity is there? And some exchanges, the peg is wide open. So that makes it very difficult to use it because it becomes more of an investment than cash. Only 2 stablecoins in the world, I would say, have sufficient liquidity globally that you could argue that the peg is so tight, the spreads are so tight that you could look at them as equivalent. So that's USDT from Tether and Circle. Tether is by far the biggest. They operate outside the EU. It's not authorized in the EU, but it's the first one, the biggest one, has had traditionally a lot of trust from its users that they can always redeem it for cash because of the secondary market. So you see the global sound, many, I think the latest statistic was something like 400 million people are holding USDT Tether as a store of value because they trust that it can be exchanged. I think that's difficult for corporates. This is a retail story. For corporates, I would look at what I mentioned earlier, redeemability. Who is the issuer, and can I get to the issuer? And then how can I make sure that the issuer behaves in accordance with the regulation, and that the money is still there? And where is the money stored, right? Which form, which bank? So if I look at under MiCAR, the regulation in Europe, there's a mandatory requirement that currency-backed stablecoins, you need to maintain at least 30% of the reserves that are backing the stablecoin. You need to maintain it in cash with credit institutions that have a registration in the EU. Now you can spread that across multiple credit institutions, and that makes it actually quite safe for that cash portion. Arguably safer than if you've got all your money sitting with one bank. And so in a way, you're reducing counterparty risk there by adopting the stablecoin. Now, a maximum of 70% can be invested in yield-bearing instruments, but also that has been tied down massively. So it can only be in highly liquid financial instruments with minimal market risk or concentration risk, meaning that you can't just put it with one issuer of money market funds because that's concentration risk. You need to be careful if you're doing it with one small EU government issuer of debt. There might not be a liquid secondary market in the debt, right? So you need to be confident that there's no haircut for the debt if you need to liquidate quickly. So that's what the rules say. Then the reserves need to be such, at least that's the way we look at it. Let's say we have a lot of stablecoins out there, it's backed, but there's, for some reason, our company goes under, is in a default. You can bet that there's going to be a bank run on the stablecoins that we issue. Everybody wants to get their money out. So by law, also, we have segregated the customer funds, the funds backing the stablecoins, completely from the company assets. So you need to have a segregated structure. So in the event of a liquidation, you want to be able that the liquidators can basically ensure that everybody gets their money back. And that structure is audited, and of course, it's part of the regulatory compliance.
The worst that can actually happen is that you have to wait a little bit longer when redeeming. Like if there is this bank run, which you'll talk about, 30% is, well, instantaneously redeemable because it's held in cash at the issuer. And the other 70% is invested in short-term investments, but there might be some delay in when you can redeem it in the worst case scenario. Is that how I should look at it?
Yes, and the investment is only with government debt in the same currency that the one you're issuing. So we would invest only in AAA bonds from the Dutch, for instance, Dutch and the German government. And for our US dollar, we back it with US Treasury. So, and that's exactly it. And we design it in such a way that we can liquidate our entire reserve within 5 days.
Okay.
So 5 days waiting time is plus some admin time. I think that's important. Now the other thing is that's the rules. That's one thing. And to be compliant with the regulation, you need to have a license first of all, and then you need to state that you are compliant. Now, then it comes down, okay, so anybody can say anything. How is that being verified? So it needs to be audited. So there need to be regular proofs, attestations of your compliance. It also comes down to the regulator. How strict is the regulator? How confident is the regulator when they gave you the license that you are sufficiently well set up to be able to professionally administer this instrument? Meaning you need to have segregation of duties. You need to have your AML and your counterterrorism financing procedures well in place. And that's all checked. You need to evidence it. There's audits, all those things, right? So the quality of the regulator becomes an important part of the confidence that a user can have in the level of compliance you have with the regulation. The regulation should give you the confidence that you can redeem, but the regulator should give you the confidence that you're actually playing by the rules. Now, the next thing is the cash components. Where are you putting that? And so if you're putting that in a small bank somewhere, then, and it's a significant part of the balance sheet of the bank, that's a concentration risk in that bank that you should not be taking. If your bank has a triple B rating, for instance, maybe that's not a great place to put it. Maybe that's not sufficiently robust and give confidence. So as a corporate treasurer, if you bank with A+ rated banks normally as a minimum requirement, and your shareholders require you to do that, you don't really want to use a stablecoin for balances where the reserves are in a triple B bank, because you'd be in breach of your duties. So then your universe of issuers gets narrowed to certain jurisdictions from a regulatory perspective, and then the reserves also need to be in with credit institutions that meet the rating requirements of your shareholders and the market. And that makes, let's say, the universe of potential issuers quite small, actually. So, and it doesn't play in all sectors, but in some sectors, particularly if you're talking large amount corporate treasurers that are not hired to take risks with the company cash, I think it's a key consideration.
Okay, and so this regulation is quite important because it signals the quality of the stablecoin issuers. If you look at risks for corporates specifically, what other types of risk are quite important? I can imagine that if you hold assets on a blockchain, the operational processes are quite important. Who can manage a wallet? Like, is there like a separation of duties
Yep.
for ICE principle? Those kind of things. Do you see companies, struggling with setting that up? Or is it like as easy as setting up a bank payment environment where you just say, okay, this person is allowed to enter the payment, this person can sign it? Do you have the infrastructure already built in for stablecoins as well? And how are companies typically experiencing like getting onboarded to this type of payment?
I think the tools are there now to facilitate that. Absolutely. And even what they call, you've got two types of wallets. You got self-custody, where you're responsible for basically your keys, essentially, and access. And you've got custodied wallets, where you rely on a third party, almost like a bank, to make sure that the operational complexity and operational risk is taken care of. So if you lose your key, you can always call the help desk and they give you a new user, a new password, and you've got access again. See, the two worlds are really merging, where self-custody user experience becomes much more like a custody wallet, and that the tools related to signing are there, and I think ultimately more flexible as well. You can do way more configurations in terms of who needs to sign for what, and I think that one is largely solved. The technology and the vendors are there to provide that kind of solution to do that. But it's still, and I think stablecoins are an interesting angle, and there's a little bit of in a way, a benefit that's with stablecoins that's comes with the regulatory compliance, is that crypto assets don't have. So if you transfer, let's say, a Bitcoin from one address to another, it's completely done. If you transfer a stablecoin from one party to another, if you lose your private key but you know the wallet, and here I'm really swearing in the church of decentralization and crypto ethos and stuff like that. But stablecoin issuers, because you're already trusting a centralized counterparty, right, with the money. So let's take that into account. Stablecoin issuer can actually freeze the transaction that has been done, burn the tokens, and issue new ones, because the actual money is still sitting safely in the bank. Nothing has changed. The value hasn't gone. The value hasn't moved. It's just almost like a warehouse receipt for that money has moved, and you made a mistake. So you scrap the receipt, issue it again, and there you go. And I think that should give comfort for users that, yes, there's operational risk that you need to get your head around, but ultimately there's also fallbacks that you don't have with the pure crypto assets.
Yeah, and how is this used in practice by these stablecoin issuers? I can imagine that it feels The ability that they have to at any moment freeze your funds is quite scary for some, even though a bank could theoretically do that as well. But how is this typically used in practice? When does this occur? Is it only in case of theft or fraud, or
Yeah,
what do you see
it's
there?
mainly. I mean, the published cases are for that, but it's also used for this case. A lost key. I think the days
Okay.
are gone. If you use the appropriate tools, you've like a address book. So I would not be transferring my stablecoin to a 16-digit key address. I would transfer it to Jan-Willem because I've already whitelisted your key and address, so I know exactly where to send it. And there's no typo, right? It's select from drop-down
Yeah.
list. But the usually it's used in law enforcement cases, correct, where regulators, law enforcement agencies request issuers to freeze or claw back certain funds. Now, that one is an interesting one because it can be quite arbitrary. So for us, the way we look at that is, yes, we are able to do it. And if it's a company with the appropriate authorization, we will comply. But if it's a request from a enforcement agency that is phishing or that doesn't have the required authorization from the judge, then we will not comply necessarily. So it's not for phishing. It's not for facilitating access to enforcement agencies that we like and refusing it for ones that we don't like. It needs to be very, very strict and needs to be for legitimate reason accompanied with evidence.
Yeah, that makes sense. And maybe also give some peace of mind, because I think that operational risk is quite real indeed, by definition for a blockchain transaction. You make it to the wrong address. Well, with a bank, you can still probably stop it or recover it at some point. But in essence, stablecoin companies have that ability as well.
And I think also to that point, and this is probably a risk, that an AML risk that corporates should be aware of as well, that if you get paid in stablecoins by parties, you need to do that via venues that have a legal and a regulatory obligation to verify the origin of that stablecoin and the provenance of that stablecoin. Because the risk is you get paid by your client, you have it in your wallet, then somewhere in the trail 3-4 steps before that client, there was an actor from a sanctioned country, a sanctioned wallet. Now, the authorities may request the issuer to freeze the money that's currently sitting in your wallet. So suddenly you think you've got a balance, but you can't access it. And so you need to be confident about where the money comes from. And I think that's something that, so you want to work with the right parties. What we tend to do, the way we try to solve that is that we, particularly for corporates, we only issue fresh money. So if the balances are held with us and they want a stable coin, we will mint it on the spot. So it's always clean and fresh. We've done our homework. We are basically, it's a new coin, so there's no history either. And you can trust that that's not going to be seized in any enforcement action.
Yeah, and I was thinking from the corporate perspective. So suppose, companies do not immediately redeem, but at some point, the stable coins remain in circulation for a longer time and are circulated multiple times. I think when it's a known supply chain that you're dealing with when it comes to payments, the risk is probably not that big. But when you're like a retailer selling stuff online and getting paid, offering the option to get paid in stable coins, you can have new buyers whom you do not know. And there I can see the risk is bigger that you're accepting a payment or a payment is made and later it turns out that the funds were stolen or the stable coins are stolen.
I mean, it's like in the real world. So you might be taking paper cash and you have it in your till and the serial numbers on it. And at some point somebody says, hey, your serial numbers, they are part of a list of fake bills, fake cash, or have been in this particular bank heist. So therefore, you need to hand them in. It's exactly the same thing.
Yeah.
And the good thing about, I think, blockchains, and because it's digital, there are good tools to do that verification. They check it against all kinds of databases, check it against, there's millions of wallets have been sanctioned and have been flagged. There's good tools to track every single movement. It's one of the dumbest way for criminals and fraudsters to move money is to use stablecoins because it's so visible and traceable. So I think the risk that you get stuck with something that is with a nefarious origin is lower than with physical cash.
Yeah, I do agree with you. Well, always interesting to think, because we're in a moment in time where a lot is happening when it comes to technology, not only on the payments technology, but also on surrounding technologies such as, for example, AI. We see a lot of different agents and even fully autonomous agents appearing. The technology is here. There's a lot of talk about agents at some point going to transact more and more by themselves. So they get their own payment tools. And of course, for an agent, it would be very hard to do a KYC and open a bank account. How do you see this evolving in the future when it comes to agents holding stablecoins and transacting with it to buy goods and services autonomously? I can imagine that can be, well, if you really think of it, quite a big growth opportunity for stablecoin usage.
Oh, absolutely. I think agents, because it's all digital, the only way to pay indeed is with stablecoins or with a credit card number. You see Visa and MasterCard and the agencies are already playing into that one big time. But yeah, there's a number of challenges with it, and there's a couple of companies that we work with as well that are experimenting in that field with agents that are transacting, and it's quite inspiring because where you see that you think that stablecoins operate in a lawless world where anybody can move money to anyone, right? And I think that is true, and those are conscious decisions. But if it's an agent that is holding your money and goes out shopping, suddenly becomes very important that the shopping only happens from trusted other agents or trusted sites. And that requires almost like programmable money that you see emerging in certain use cases as well, in terms of like what they call purpose-bound money, where you can program what the money can be spent on and with whom. So you've got these lists that you get protocols that expose, let's say, the credentials, and then the agent can decide whether those credentials fit their mandate. So you see this whole register that's currently it's 5-star ratings for hotels and restaurants that you do on TripAdvisor, others. You'll start getting that for agents, merchants as well, services, except that it becomes way more important because it's a very objective. Like you and I would go through the reviews on TripAdvisor and think, well, that's fake, that's fake, that's fake. Oh yeah, that makes sense. So, but if you, with agents, they're going to say, oh, 5 stars, yeah, mandate, da. So it becomes very important that those criteria are measured and accredited independently. That's one thing. The other thing indeed is, are you gonna, and this comes back to liquidity management, and because the beauty about stablecoins, because money moves so fast, you don't have to have big buffers. You can have your money working in those type of tokenized money market funds and only take out piecemeal just 5 minutes before you need it. Now with agents, if you are, let's say you got 500 agents running around or 10,000 agents, you're giving them a wallet with €100 each. That's 1 million euros in exposure and liquidity, idle money that's doing nothing, that is sitting there with agents that are running around doing God knows what. And apart from the working capital that's being locked up, I'm not sure whether it's desirable. So the speed with which you can replenish those wallets of agents, and the cost of doing that, like if it costs 1,000% to add half a cent to an agent wallet, then maybe, and it takes only 1 second, maybe that's a better way to manage your exposure as well, right? So, and it comes back to, again, so how much do the rails cost? How fast can you do that? So the amount of liquidity that you're financing sitting with agents is also one of the big pain points. So yeah, it's a fascinating new topic, and there's some really cool experiments happening. But I think personally, I wouldn't necessarily give my bank account details and passcodes, etc., to an agent just yet.
Yeah. Where do you see stablecoin as a payment methodology in a few years' time? And what would be the role you foresee in corporate treasury operations?
I see it as the biggest opportunity to um, reduce a number of cost factors. And I'm not even sure whether in a couple of years corporate treasuries will actually use stable coins in its raw form, like going into a wallet and moving it and stuff like that. I think it's a tool that is abstracted, the complexity of which is abstracted away. But I mean, if you look at I think it always will have to do something with payments or being able to access yield products with instant liquidity. Ultimately, the goal we look at it as money is always working. It's either accruing yield or being productive. And if it's not, it's in transit towards a supplier or you're receiving it from a customer. And that transit time is only a few seconds. And so you haven't got trapped cash. You haven't got cash sitting in pre-funded buffers that are sitting somewhere. You don't have trapped cash sitting in, being stuck in their correspondent network. You don't have unproductive buffers that are sitting there that are just in case. So moving from just in case settlement and liquidity to just in time, I think is going to be the big shift because we are removing the brakes. There's no speed consideration anymore because it's instant, it's global, and there's no rails cost consideration because it costs a fraction of a cent. And so it reduces it, and that's incredibly transformative. So you can take your money if you need to settle at 5 p.m. And I'm making it exaggerating now, but it's something that we're actually working on, and I'm pretty sure we get close to it. If you need to settle at 5 p.m. European time, so what's that, 11 a.m. local time in Colombia, to get coffee released from a producer there into a warehouse, and they will only give you the coffee once you've settled in that wallet. You can basically take it out of the productive of your money market funds, let's say 1 minute before you need to settle, and it will still arrive there. Now, that means that you don't have to maintain buffers there to achieve that. You don't have to have local bank accounts. You don't have to provision for that cash 2 days beforehand. All that stuff goes away and the money is always working. So your costs in terms of rails go down, your FX risk go down, your settlement risk go down. Any market risk that you might have on, for instance, commodities is extinguished. So all your risk mitigation costs, which can be substantial into hedging, that's gone. There's no cash drag or very little because the money is always working. So your return on operating capital increases instantly. And because there's no trapped cash, your working capital capacity increases. And if you're running a business in demand and a product, you basically will increase your top line as well because you've got more capital to deploy or reduce your credit costs. So it's incredibly transformative. And I think once the complexity is abstracted and it's getting more and more adopted, I think adoption will be incredibly quick because the competitive advantage it will give to certain types of companies is just incredible, and the competitive disadvantage will very quickly destroy your ability, your position in the market, because those cost savings will be passed on to the clients ultimately, and you'll see that emerging. So I think it's an absolute imperative that companies start looking at this, and I'm not, to say, preaching for my own parish. It's exactly why I'm doing this job, exactly why I'm excited. But you should start looking at it, start experimenting with it, because in some settings it can be absolutely transformative.
Yeah, looking forward to seeing that evolve. One treasurer a couple of weeks ago asked me, like, can stablecoins also be used to move money out of countries where it's hard to move money out of? Like, for example, take Brazil. It's if you want to have a company, a subsidiary in Brazil, and you want to, they have excess cash that you want to get to the group treasury or the the holding, it's quite hard to get money out of that country. Do you see stablecoins playing a role here as well, or is it still blocked by by legislation and?
Well, I'd hate to think that stablecoins would be used to circumvent the law.
Mhm.
I don't think that's a sustainable way to operate, and I don't think it's a sustainable solution. It might help a few times, but ultimately there's the regulation is there for a purpose, and I think whether it's cash or stablecoin, it will have the same treatment once the
Yeah.
law catches up. At the moment, there might be a gray area where stablecoins are seen as commodities rather than funds. So, hey, it doesn't apply. But I think it's a temporary thing. I think where the opportunity is going to come in is, let's say, liquidity in secondary markets, and particularly for the big foreign currencies. So, why is it hard to get money out? First of all, to a large extent, is that companies need that foreign currency for their imports, strategic imports. And because of the lack of access to the correspondent banking network, they rely on the exports to actually get that foreign currency in. Now, if you can start putting, let's say, if you can bypass or the need for a correspondent banking network, and you can tap into global liquidity pools of foreign currencies in the form of stablecoins that move around very, very quickly, then suddenly you've got a way to start moving the money. And the liquidity in those order books for instance, USDT versus a Brazilian reais will start increasing, and the spreads will get tighter. And then it becomes a matter of reporting rather than that you can't do it. And I think that's where we're heading. In the short term, there may be some regulatory arbitrage that makes it possible. I would probably, let's say, that's not a purpose that we would be comfortable with in terms of onboarding a customer, because we want to know the purpose, of course, of the money movement, and that's not immediately the one that we would prioritize. Let's put it that way.
Fully understand. And for corporate treasury teams that are looking to get started, maybe in a small experimental way with stablecoins, what would you advise them to do? Or would you advise to wait and see until stablecoins become a very dominant form of payment? Or can they already start to do maybe some little experiments today and then work with a staged approach in order to get more hands-on experience with this form of payment?
I think if you're gonna have stablecoins in your mix eventually, and let's say there's 100% chance that you will eventually, then I think you need to understand the operational risks that are associated with that technology and those rails. Even if they're abstracted away, you need to be able to evaluate the solution vendor that abstracts away those risks. So I think you need to get your hands dirty a little bit just to learn what you're dealing with. And I sometimes compare it to, and I have this, I've of an age that I remember when Skype was introduced, right? And I was living in New Zealand, and my family was in the Netherlands, and we used to use voice over IP calling, but it was very, very cumbersome, very difficult to do, and very painful. It usually didn't work. It broke down. So, especially with my parents who were getting a bit older then. Now, when Skype came in, suddenly the user experience changed. And I was excited because, hey, I can make this call, and I'm going to do that outside of the telcos. I'm not using the regular fixed line or even the mobile. I'm doing this via the internet, completely free. Amazing, right? So, but I had experienced the pain. I understand how new technology works, what the difference is. And then I was on my way. Now with stablecoins, I don't think you need to start at the protocol level and figure out how that works. But if you don't have a crypto account with a crypto exchange, I would probably do that, to be honest. Open up an account and understand the complexity of the onboarding. So what questions do they ask? And it's familiar to a bank. So you understand the level of regulation. You can experiment with sending money from your bank account to the crypto exchange and then suddenly see a balance appearing with a strange number in front of it, which is your account number. And you can then take that balance and swap it for a stablecoin. Right? So, and do that a few times. Once you're confident with that, send it to someone on another exchange or another wallet with a particular address. I think that experience will give that sort of that Skype feeling from, hey, I can move money and I didn't use a bank in this one. And it gives you some exposure to the complexity of it. The other thing is I would look at potentially custodians, like who would be taking away some of the complexity of the operations, that it becomes more like a banking portal, and look at the user interface. So I think I do look at that. Then I'd start to potentially work with a key customer or key supplier that you're always paying with, and where it always costs money. And there's always calls in terms of where is the money, and say, well, why don't we try this with a stablecoin? Right? Figure out, work with a party that can help you take away some of the complexity to make that happen. So those are the steps I would take. And I would seriously look at, probably later this year, tokenized money market funds, tokenized yield instruments, because that in itself is going to be a fantastic revolution.
That sounds like an amazing playbook, and I think also quite low barrier to start with. The different steps are, well, don't take that much time, I think, to set up.
And I think there's an intermediate way, right? So this is also where we're looking at it. Remember I spoke about the various forms of money. E-money sometimes is an underappreciated money form that, given all the excitement for stablecoins. Stablecoins are the shiny new thing, but e-money is actually a very strong solution. That requires a number of almost the same things. You need to fund it from a bank account. You see the balance appearing. The balance is not with a bank. It's suddenly with something that looks like a bank, but is not a bank, and you move money around. And that's another way to do even more careful step. And then from there, move it to stablecoins to that. There's multiple ways, but yeah, I think the risk, getting your hands dirty is one way or another is probably the place to start.
Final question, Arnoud. What is perhaps the most controversial or against the norm idea about the stablecoin space that you want to take away?
I think stablecoins are getting a level of press that reminds me of the early blockchain days, where there's like a hammer looking for a nail. So it's not a solution for everything. And despite there's a lot of hype, and some of it is justified, but it's not necessarily the right solution for everyone. And I think it's careful evaluation of, let's say, of what you're trying to achieve before you embark on that, because it could just be a shiny thing that doesn't add any value. So yeah, I'm probably not saying something that is appreciated by all my peers in the stablecoin industry, but that's the way I see it. Reality is that I don't think anybody really wants a stablecoin. A stablecoin is not a business model in itself, because there's only one company that has a business model, but that's Tether. And the rest needs to find ways to make it a solution. And if I look at companies that we work with, they want to figure out how to solve that treasury, the devil's trilemma, right? So but for instance, they just want to get paid faster. They want to that's it. At just a lower cost, and there's other ways to achieve it than the stablecoin. So don't confuse the goal with the solution. And sometimes the solution is presented as the goal, but it's not.
So at some point, we shouldn't even be talking about stablecoins anymore, but it should just be a means to an end.
Well,
I think,
look at it like this. I think visually or conceptually, you're sitting behind a terminal and you say, I need to pay Jan-Willem, and I want him to be paid at 5 p.m. You do that in the morning at 9. That's it. That's all you should be able to do, right? And then there's a optimization that happens, probably with AI, that says, Jan-Willem, he's based in the Netherlands. I'm in Malaysia, so how am I going to do that? So, and then you know that it's because of the predictability of blockchains. You know how fast it will settle. You know that it's only going to need 4 seconds before it's in your wallet with finality. It's going to take the machine 1 minute to get it out of a tokenized money market fund. So that's to be safe. If I give an instruction to pay you at 5 p.m., then 2 minutes before 5, the machine will take it out of the money market fund, send it your way, and you get paid. That's the only thing you should know. You should not have to deal with wallets and stablecoin, what blockchain, all those things. So this should be for the machine to figure out.
Well, amazing. Arnoud, thank you for sharing all these insights. I think it offers a lot of value for corporate treasurers. Thank you, and looking forward to talk to you again.
Likewise, thank you for the opportunity.